Good afternoon, and welcome to today's seminar on digital taxes and the inclusive framework on international taxation. This is the first in our series of quarterly tax perspectives on tax. Thank you for joining us today. Before we start, there should be a slide appearing that will show you certain housekeeping matters you might want to review. Okay. My name is Ronald Nobrega. I'm a partner in the tax group at Fasken Martineau. My practice is focused on domestic and international tax matters. I'm joined today by my colleague, Paul Casuccio. He's the leader of our global commodity tax and VAT practice group, and he works exclusively in that area, providing advice and dealing with disputes with CRA. Okay, we'll jump into our agenda. I will be going first, dealing with the digital taxes and inclusive framework proposals. These proposals have been led by the OECD. In the past, we were used to the OECD just dealing with tax matters in terms of their model tax convention and transfer pricing guidelines. But over the last decade, they've produced numerous reports leading up to their 15 action plans, which have under the base erosion and profit sharing initiative. And that has led to legislative amendments across the world, including in Canada. Today, we are dealing with the two pillars of taxation on dealing with the digitization of the economy. That's a hard expression. But once we're even done with this, and this will probably take us a couple of years before these pillars are implemented, the OECD has at least 5 more initiatives in the works, so they won't be done with us for quite a while. Going to the next slide. Since 2017, the 140-member inclusive framework and the OECD have sought an agreement on a more appropriate taxation system to address the digitization of the global economy. Pillar 1 focuses on shifting some of the income tax base to source countries where customers are located, on the basis that the traditional rules regarding residency and permanent establishment rules are not adequate in a digitized economy, which allow taxation to be minimized or avoided if we're just based on residency and PE. Pillar 2 is meant to impose a minimum tax of 15% on the largest internationally operated businesses. And this is seen as a backup to the OECD's base erosion and profit shifting measures that were adopted in the 15 BEPS action plans. So up to the next slide, and actually the next one. I covered off that as well. Now I'll deal first with some of the background to it. Most European countries were very supportive of Pillar 1 because it would allocate additional tax base to their countries. Prior to 2021, the US was not at all supportive because it dominated the digital economy, digital services in most international markets outside of China. Some countries leading up to the Pillar 1 and Pillar 2 negotiations that were finally settled were proposing their own digital services tax if Pillar 1 was not successfully implemented. That included Canada. The US did threaten sanctions if countries imposed their own digital services taxes. Next slide. All this changed in 2021 with the new government in the United States. And it decided to pursue a Pillar 1, Pillar 2 solution in order that it could get a minimum tax internationally. So the US was willing to give up some of its tax base, some of its potential future tax base under Pillar 1 in order to get a minimum tax under Pillar 2 to combat what it thought was aggressive reductions in tax rates globally that were undermining not only its but other countries' taxes. Going to the next slide. So in June of really the summer of last year, the G7 and the inclusive framework countries endorsed a Pillar 1 and Pillar 2 agreement, largely based on US proposals. And that included 135 countries agreeing to these proposals, and that includes many tax havens such as Bermuda and Cayman Islands, and countries representing 95% of global GDP. The G20 has called for the resolution of certain of the tax issues and design issues in the implementation of Pillar 1 and Pillar 2. They called for that for October 2021, but we have only so far received rules for implementation of Pillar 2, and that was only in December of 2021. We're expecting further publications from the OECD in the coming weeks and months. Next slide. So I'm going to deal first with Pillar 1, and I'll start off with its scope. It will apply to the largest M&Es, multinationals, those having annual gross revenues over 20 billion euros and a ratio of earnings before tax to revenues of at least 10%. The revenue threshold may be reduced in future years to just 10 billion euros, and that will only commence though after the plan has been implemented for seven years. So we wouldn't see that until at least 2030. And there will be exclusions in terms of scope for regulated financial institutions and extractive companies such as mining, oil and gas companies. Overall, though, the $20 billion threshold will limit Pillar 1 to the largest multinationals. Go to the next slide. So the next question is Nexus. And when I refer to an allocation of amount A, that is really an allocation of tax base. So there will be an allocation of amount A to a market jurisdiction where services are provided, where the Inscope, where the multinational is providing services that drive at least $1 million euros of revenue annually. That will be reduced to just €250,000 in smaller countries having lower GDPs. Next slide. In terms of the quantum of taxation, the shift of tax base, between 20 and 30% of residual profits would be transferred to market jurisdictions. And by residual profits, that's really excess profits, profits beyond that 10% margin that I mentioned. Profits and losses will be determined using financial accounting income and with a small number of adjustments. Losses will be carried forward for the group. Go to the next slide. There will be very limited segmentation in these rules. In general, it'll be just a multinational will determine whether or not it meets the thresholds. But in some cases, a multinational may satisfy the 20 billion euro revenue threshold, but not the profit margin threshold, but itself have segments that do satisfy that profit margin threshold. So where that is the case and that information is provided in its financial statements, that multinational would be, if that segment has itself 20 billion or more euros of revenue and meets the 10% margin threshold, that segment will be subject to tax under Pillar 1. This would not apply to many companies, partly because Pillar 1 does not apply to many multinationals in any event, but it would apply to a company like Amazon that has, overall lower profit margin, something below 10%, but has a web services business that generates itself 20 billion euros in revenues and it meets that profit margin threshold. Going to the next slide. This slide just really points out that no amount A would be allocated to a market jurisdiction where under traditional rules, it already has adequate allocation of tax base. So if a multinational will pay more tax under traditional rules in a particular jurisdiction based on its permanent establishments, it would not have an allocation of amount A to that jurisdiction. Next slide. This slide deals with the elimination of double taxation. Obviously, amount A, the allocation rule will overlap with the traditional rules of permanent establishment and residency. So there's a need to have a mechanism to eliminate double tax. And the first step is to identify which entities will be paying tax under amount A. And then the residency country would be expected to exempt that income that's been shifted under Amount A to market jurisdictions, or to provide a credit against its own tax for the tax paid in the foreign jurisdiction that has had an Amount A allocation to it. The inclusive framework, the OECD is really endorsing either this exemption or credit method. So jumping to the next slide, I'm giving you a quick overview of Pillar 1. The most recent OECD guidelines or report on Pillar 1 was about 300 pages long, so obviously this is very much an overview. But jumping to Pillar 2, we now have a report on Pillar 2, including proposed rules for countries to adopt. Pillar 2 will have two components: a new domestic tax rule referred to as the Global Anti-Abase Erosion Rule, and a treaty-based substantive tax rule. Now I'm going to jump to that first of those two, the global rule. If you flip slides, the OECD published global rules on December 20th, 2021. That was supposed to be back in October, but there was a delay. And these rules ran on for approximately 70 pages. And these would be the rules that each country would be expected to mold into its own legislation. So at 70 pages, we'll likely have a similar number of additional pages added to our Income Tax Act. And I think they'll probably be included in a new part to our Income Tax Act. The global rules will be composed of two sets of provisions: an income inclusion rule, that is the basic rule, that is to impose tax on a parent entity where it has low taxed subsidiaries. And as a backup, there will be an undertaxed payment rule that where the income inclusion rule isn't applied, or is not fully applied to income that would otherwise be subject to it, there will be a set of denied deductions under the undertaxed payment rule in other countries to effectively increase the multinational's tax rate in that jurisdiction to 15%. Jumping to the next slide. The global rules will apply to multinationals having businesses that earn at least 750 million in annual gross revenues in at least 2 of the last 4 years, and that will be determined based on the ultimate parent company's consolidated financial statements. Countries are able to have lower thresholds if they wish, but only for multinationals that are headquartered in their jurisdiction. Covered taxes obviously will include corporate income tax, but it will also include taxes that are imposed in lieu of income taxes, sometimes franchise taxes, taxes on retained earnings or on equity. Generally, a multinational group will be what you expect, a group of companies that are related or have common ownership or control with an ultimate parent that consolidates for financial accounting purposes. Next slide, please. There are many entities that we excluded from the global rules. Those will include government entities, international organizations, not-for-profits, pension funds, many investment funds and real estate investment vehicles that are ultimate parent entities or are closely held by ultimate parent entities. There's also a general exclusion for international shipping income. Next slide. So as I mentioned, under the global rules, the top-up tax rate is 15%. So you would compute an effective tax rate for a jurisdiction by dividing covered taxes in that jurisdiction for all entities, for all group entities in the jurisdiction, by profits in the jurisdiction. And where that is less than 15%, you'd have a top-up to which a tax would apply. Income and income tax will be computed based on financial statement amounts using either IFRS or, in certain cases, local country GAAP. So we're not using each country's own tax computation under its income tax provisions, but we're using financial statement accounting, statement amounts. There will be, though, numerous adjustments for income and taxes as computed under financial statements. And these adjustments will add a great deal of complexity to the statute, as we'll see when this is implemented. Jump to the next slide. Just some more background rules. Transactions between multinational group members in different states will have to use the same amounts, and those amounts must comply with the arm's length principle. The global rules will permit losses of a multinational to be carried over, and will also allow low tax rates in one jurisdiction. Low tax rates in a jurisdiction for one corporation will maybe offset by higher rates in another corporation in that same jurisdiction. Global rules will also provide for a carve-out to exclude income a carve-out that is essentially equal to 5% of the carrying value of tax tangible assets and 5% of payroll. That will be the ultimate amounts. Starting up, those numbers will be 8% of tangible assets and 10% of payroll. But over a 10-year period, those thresholds will each be reduced to the 5% level. And why would they have this carve-out? The reason is they only want to have the global rules apply on what they consider excess profits beyond a normal return. So they're thinking of income from intangibles and other matters that give rise to base erosion and profit shifting concerns. Next slide, please. So, as I mentioned, the minimum tax rate is 15%, and where the effective tax rate in a jurisdiction is less than that amount, a top-up would apply. And the top-up is essentially the difference between the tax rate in that jurisdiction and 15%. And that would be applied to the excess profits, as they call them. Now, that level of tax could be satisfied in the market jurisdiction if they have a special tax to top up their own tax where the 15% minimum rate isn't satisfied. If that isn't done, then the top-up tax is to be paid by the highest tier corporation in the group that is located in a jurisdiction that has an income inclusion rule. Jump in the next slide. Where that isn't satisfied for whatever reason, perhaps where the top tier corporation is located doesn't have an income inclusion top-up rule, then there's an under-taxed payment rule that can apply, and it will deny expenses of the entity with having the entities having the low rate of tax, and that top-up, that denial rule will be available in jurisdictions that are relevant that would be allocated based on tangible asset value and total employees in the jurisdictions that have adopted a UTPR rule. Jumping to the next slide. One thing not dealt with in the December 2021 rules put by the OECD was the substantive tax rule, which is the treaty-based rule. So what this is, and there should be a report coming out in the next few months on it, and it's a treaty-based rule, and it is meant to benefit developing countries by allowing them to tax certain payments such as royalties, interest, and other cross-border amounts, where they would ultimately be taxed in the recipient jurisdiction at a rate lower than a substantive tax rule minimum rate, and that minimum rate is to be set at something between 7.5% and 9%. So when we have these such low taxed payments, the paying country can top up or apply tax on these payments equal to the difference between the 7.5% or 9%, whatever is applicable, and the rate of tax applying in the recipient country's jurisdiction. Okay, so I just mentioned that the computation of the STTR is based on that 7.5% or 9% rate, and what the actual rate of tax is in the recipient difference can be taxed by the paying country. Developed countries are supposed to agree with developing countries to the STTR, the subject tax rule tax, would be a covered tax under the GLOBE rules. So turning now to the next slide, I just want to go over some implementation concerns. These rules are planned to come into effect in 2023, so timing is very tight. A multilateral instrument for Pillar 1, Amount A of Pillar 1, is to be available and ready for signature in mid-2022. Now, we haven't even seen the rules for that Amount A, so that's a very tight timeline. And it's contemplated that Pillar 2 would all act in 2023 with legislation implemented in 2022. The U.S. is critical to implementation. Almost 2/3 of the Amount A in Pillar 1 is estimated to be coming from U.S. multinationals. So obviously U.S. Politicians are not very enthusiastic about giving up some of their tax base. So that will be one problem. And there are elections coming in the United States. So even though the U.S. administration is on board, there could be changes in Congress. Any treaty changes to implement the STTR would require U.S. Senate approval, which is generally a 2/3 approval level. Flipping to the last slide, these are just some Canadian concerns. Paul will get into the digital services tax, which will apply if Pillar 1 isn't implemented. I note that Canada doesn't use consolidated income for tax purposes. It doesn't use accounting income for tax purposes. So these will be new systems, new rules for our Income Tax Act, and will add some complexity. It is not clear how the global minimum tax will integrate with our FAPI rules. We'll be providing as foreign accrual tax, tax paid by a parent company. That'd be a little bit unusual. And the rules under Pillar 2 aren't consistent with the policy objectives of our famous paragraph 95(2)(a), which is actually meant to strip income out of high tax jurisdictions into low tax jurisdictions. So minimum tax will reduce that policy choice of the government, and it reduces the benefits of our exempt surplus system for in-scope multinationals. So that was meant to be an overview of Pillar 1 and Pillar 2. There'll be lots of legislation coming. And now I'll turn things over to Paul to talk about the digital services taxes. Thank you.
All right. Thank you, Ron. And thank you again to everyone for joining us today. With the time that we've got left, I'd like to talk to you about two types of tax that are designed to allow Canada to tax the digital economy a little bit more effectively. The first is the new Canadian digital services tax that Ron mentioned. And the second are various indirect taxes on digital property and all types of services. Now, although both types of tax serve the same ultimate goal, they're actually very different. The digital services tax is a federal tax on specific types of revenues earned by sellers of digital services and property, while the other taxes we'll talk about are both federal and provincial sales, use, and value-added taxes, and they're imposed on Canadian purchasers of both services and digital property. The various thresholds for compliance with these taxes are significantly different, and although there's some overlap, the tax base for the indirect taxes is generally much broader than for the digital services tax. But ultimately, all of these taxes are reported and remitted by the sellers of such digital property and services. And so if your respective entities are in that business, these are the taxes that you need to be thinking about right now. We can flip over to the next slide. Thanks. So let's first talk about the new digital services tax, which itself is actually a little bit of a misnomer, since it's a tax not only on digital services, but also on the sale of certain intangible or digital property. The first thing you need to know is that this tax has not been enacted yet, and actually may never be enacted. And this, of course, is in contrast with the indirect taxes on digital property and services that we're going to discuss later. These are all presently enacted and in force. So the digital services tax was first announced conceptually at the end of 2020. It was again discussed in the 2021 budget early last year. The present draft legislation was only released this past December, and until yesterday, Canada's Department of Finance was still accepting comments from stakeholders on the legislation. The planned implementation date for this tax hasn't been set yet, but it has been determined that it will be no earlier than January 1st, 2024, but then only if the Pillar 1 multilateral treaty that Ron was just speaking about hasn't been implemented yet as of that date. This tax is really designed to be an interim measure until such a treaty has been signed, but until then, the tax is intended to apply. And although the implementation date isn't until January 1st, 2024 at the earliest, tax is actually going to apply to revenues that have been earned from January 1st of this year. And so that first tax return, if this tax is in fact implemented, is going to potentially be a doozy. That first tax return is going to require tax to be reported and paid for 2022, 2023, and then depending on when the actual tax is implemented, any future years that end before the actual implementation date, they all have to be implemented. They will all have to be reported and remitted at the same time. We move on to the next slide now. Thank you. So before we talk specifics about the tax itself, let's first talk about who might be subject to the tax. So this is a tax on both Canadian and non-Canadian entities, but certainly not on all such entities. There's a fairly significant double revenue threshold test. Both parts of this test need to be satisfied before an entity is going to be subject to the tax. First, the entity has to have global revenues in excess of 750 million euro. And in addition to the global revenue threshold, the entity also has what's called in-scope revenues in Canada that are in excess of 20 million Canadian dollars. We're going to talk extensively about what this concept of in-scope revenue is in a little bit. Now, interestingly, the legislation actually requires registration of an entity at a lower threshold than the actual threshold for the payment of tax. So once an entity has 750 million euro of global revenue and only 10 million Canadian dollars of in-scope Canadian revenue, registration becomes required. Now, ostensibly, this is to allow Canada Revenue to start to look at these additional entities to ensure that their in-scope revenues in Canada are actually less than $20 million. As you're going to see sort of throughout this presentation, I suspect there's going to be a lot of gray area in the application of the legislation. And so I suspect there's going to be a lot of room for Canada Revenue to take issue with how the in-scope revenues are being determined. Now, it's important to note that the threshold test and the registration requirements are actually done on a consolidated basis. Now, what this means is that when applying the thresholds, all of the revenues of a consolidated group need to be added together to determine whether the thresholds have been surpassed. And for those consolidated groups where that threshold has been surpassed, that group is going to be entitled to designate a single taxpayer to register for and to comply with the tax. Now, interestingly, this concept of a consolidated group for the digital services tax, it extends beyond simply determining the thresholds and allowing a representative member of the group to register for and to comply with the tax. The draft legislation also allows Canada's Minister of National Revenue to assess any member of a consolidated group for digital services tax liability that may belong to another member of that group. And in any such case, each of those members is going to become jointly and severally liable for the tax liability. Now, I'm sure you can easily see how the minister is going to use this power to potentially assess Canadian subsidiaries of non-Canadian digital service providers in order to ease their ability to whether seize assets in Canada or encourage compliance, or even in a worst case scenario, to access Canadian resident directors for tax that would otherwise be payable by a non-Canadian entity. This element of the statute, I think, is certainly designed to make it more difficult for multinationals to avoid paying this Canadian tax. We can move on to the next slide, please. Now, although there's a lot of complicated elements to this new digital services tax, the tax itself is fairly basic. It's a 3% flat tax on revenue, but it's not a tax on all revenues, but rather only on Canadian-sourced in-scope revenues. And the tax itself only applies on those revenues that are in excess of 20 million Canadian dollars. Now, just a quick note for those taxpayers who are going to be into this system and who are responsible for self-assessing and paying this tax, I would note that it's reportable and payable annually on the 30th of June in respect of the prior year. So that first June return, that's going to include the 2022, 2023, possibly 2024, depending on when things get going. That June 30th is a date to circle in your calendars to remit a very large check. We can move on to the next slide, please. So now we know generally who's going to be taxed, and we know what the tax itself looks like. But both of these elements really do require an understanding of what Canadian-sourced in-scope revenue means. Because remember, it's only entities that have Canadian in-scope revenues in excess of 20 million that are required to pay the tax in the first place, and the tax itself only applies to in-scope revenues that exceed the 20 million Canadian dollar threshold. Now, there are 4 separate streams of in-scope revenues to consider. Each of them generally arise in connection with a digital service provider's engagement with online users that are located in Canada. The first type of in-scope revenue that we're going to deal with is referred to as online marketplace services revenue. This generally consists of revenue earned from providing a digital interface that allows users to interact with other users and that facilitates the supply of property or services, including digital content, between those users. Now, some common examples of these types of revenues would include fees charged for accessing or using an online marketplace, commissions or other fees earned from facilitating supplies between users of the online marketplace, and fees for the provision of premium services, whether it's preferential listings or any other optional enhancements to the basic ordinary functionality of the online marketplace. It's easy to think of Airbnb as an example of an online marketplace. You know, when you list your ski chalet for rent and you pay Airbnb a percentage of your rental fee, that's going to be included in their in-scope revenues, as would be the fee that you pay to keep your listing at the top of their first page of ski chalet listings in the region, as well as would be the fees that the renter pays directly to Airbnb as a service fee. All 3 of these fees earned by Airbnb would end up as revenues, as in-scope revenues of this nature. The second type of in-scope revenues are those earned from online advertising services. And this category is going to include revenues earned from facilitating the delivery of an online targeted advertisement through a digital interface, as well as the actual provision of digital space for an online targeted advertisement. The third category of in-scope revenues are those earned from providing social media services. And these revenues are going to be earned from fees charged for access to or for the use of a social media platform, fees charged for premium services or other, again, optional enhancements to the basic functionality of a social media platform, as well as amounts earned for facilitating interactions between users on the platform or amounts earned for allowing access to specific user-generated content on the platform. And then the fourth and final type of revenue that would be considered to be in scope for purposes of this tax are revenues earned from sales of user data and from allowing access to user data that's collected from either an online marketplace or a social media platform or an online search engine. If you would move to the next slide, please. So as you can see, this concept of in-scope revenue is broad for any entity doing business in the digital world, but there are some particular exemptions and carve-outs from what is considered to be in-scope revenue. Among the exemptions are those designed specifically to avoid double counting of certain revenues by the same taxpayer. For example, online advertising service revenue specifically excludes revenue earned from the provision of online marketplace services. Similarly, revenues from social media services exclude revenues earned from providing online marketplace services or online advertising services. But in addition to these exemptions that are designed to avoid double counting for the same taxpayer, the concept of in-scope revenues also have certain carve-outs and certain exemptions that exist for either reasons of public policy or to avoid taxing multiple unrelated parties for the same revenues. So at this juncture, we have an idea of how to determine what is taxed. We know what the tax looks like, and we know who is subject to the tax. But there's still one final important concept that we need to understand in order to determine whether or not your entity might be required to become registered for the digital services tax in Canada. And this final issue is determining the source for any in-scope revenues. Recall that it's only in-scope revenues that are sourced in Canada that are subject to the tax. And so we must know how to determine the source of the revenues. Now, the draft legislation tells us that the method for determining the source of the revenue is going to be dependent on the type of revenue earned. We can flip to the next slide. So for entities that are earning online marketplace services revenue, determining the source of such revenue is actually determined by one of 3 methods, depending on how that specific revenue is being earned. If the revenue is earned from facilitating a supply of a service that's actually delivered in physical form, such as the provision of a transportation service or accommodations, and that physical delivery service is performed in Canada, then the revenue from facilitating that specific transaction is going to be deemed to be entirely sourced in Canada. So again, think of this in the context of an Airbnb or an Uber. These online marketplaces, to the extent that they're allowing users to book services such as rideshare or cottages in Canada, the revenues stemming from the facilitation of those transactions, that revenue would be deemed to be Canadian sourced in terms of being an in-scope revenue for the purpose of this tax. Now, in contrast, if the online marketplace service revenue is earned by facilitating a transaction between users and there's no service that's delivered in physical form, then determining the source of the revenue is actually going to depend on where the users are located. If both of the users are located in Canada, all of the revenue associated with that transaction or with facilitating that transaction are going to be deemed to be Canadian sourced revenues. If only one user is located in Canada, 50% of the revenue earned from facilitating that transaction would be deemed to be Canadian source. And you can see quickly that it's going to be critical for anyone subject to this tax to be keeping close track of where their users are located. And in determining that, the statute and the notes from finance indicate extreme breadth in terms of determining where a user is located, including the obvious ones such as billing addresses and IP addresses. What I think will be curious to see is what happens with respect to companies or consumers that are using IP spoofing or cloaking services to make it look like they're somewhere else. And what I'm curious to see is what Canada Revenue Agency is going to require in terms of requiring taxpayers to look through or to attempt to look through those types of things to determine the location of the users. And then the third, moving back to the third method for determining whether or not an online marketplace service revenue is sourced in Canada is sort of a catch-all. And this applies in circumstances where the revenue can't be traced to a specific transaction. And in those cases, the amount of revenue that's going to be deemed to be sourced in Canada is going to be based on a formula that calculates the percentage of marketplace transactions as a whole and the participants that are located in Canada. Now, moving on to entities that earn their in-scope revenues from providing online advertising services, there are two methods for them to determine the source of their revenues. If the revenue can be traced to the display of an advertisement to a specific user, and that user is located in Canada, the revenue will be deemed to be entirely sourced in Canada. In circumstances where the revenue can't be traced to any specific user or viewer of the advertisement, then the amount of revenue is going to be deemed to be sourced in Canada based on a formula. Again, similar to the one we just discussed a minute ago, and this one that looks at the percentage of users to which the advertisement was displayed and who were located in Canada. When talking about the revenues earned for providing social media services, there's only one method for determining whether or not the in-scope revenue is sourced in Canada. And again, it's similar to that catch-all formulaic approach that exists both for the online advertising services revenue and the online marketplace services revenue. And this is by use of a formula that determines the revenue sourced in Canada, based on the percentage of the platform users that are actually located in Canada. And finally, for entities that earn user data revenue, there are two methods for determining the source of that revenue. Where the revenue can be traced to the user data of a single user, and that user is located in Canada, of course, the revenue is going to be deemed to be sourced entirely in Canada. In contrast, where the revenue relates to a set of data collected for multiple users, the revenue is going to be sourced in Canada, again, based on a percentage, in this case, of those users to whom the data relates, the percentage of those users that are located in Canada. All right, moving on to the next slide here. We've got let's talk a little bit about some of the significant changes to Canada's other taxes that are aimed at taxing the digital economy a little bit more efficiently, a little bit more effectively. Now, for any of you who may have tuned out a bit when you heard threshold revenue numbers like 750 million euro in global revenues, you may want to tune back in right now, because the thresholds for these taxes are actually much lower. They never exceed $30,000 in annual sales to Canadian buyers. And in some cases, there is no lower threshold. And as I noted earlier in the presentation, all of these taxes are in full effect right now. So what we've seen over the past couple of years have been significant changes, both to federal and provincial law, designed to expand the tax collection duties to entities either that are located outside of Canada, or even to those located within Canada, but outside of particular provincial jurisdictions, where those entities sell either services or digital property either into Canada, in the case of non-residents of Canada, or into specific provinces, in the case of non-residents of those provinces. So the province of Quebec started down this path a few years back in making amendments to its provincial value-added tax. And this past summer, the Canadian federal government imposed sweeping new changes to the federal value-added tax legislation, or GST, HST it's referred to, in order to accomplish this goal. Both of these jurisdictions have aimed their changes at non-residents either of Quebec or of Canada, primarily at those people or those entities that make B2C sales of services or digital property to residents of those jurisdictions. Now, for such non-residents who make B2C sales into Canada or into Quebec, the sellers are now going to be required to register under a simplified tax regime. They're going to be required to collect, report, and remit either the QST, the Quebec sales tax, or Canada's federal GST, HST in respect of those sales, or at least some of those sales, if not all of them. And with respect to the federal legislation, the GST, HST, the changes are far more sweeping than they were even for Quebec, because certain non-Canadian entities that are making B2B sales into Canada may also be required to become registered to collect, report, and remit Canada's GST, HST on sales made to Canadians. And the rules in this regard are complicated, and they really do put a fairly heavy burden on non-Canadians in terms of determining whether or not they're going to need to collect the tax and to get registered under this new system. For those that make B2C sales, it's easy. The answer is yes. If you're selling any type of services, whether they are sort of digital style services, or even if they're traditional services, right? If you are a non-Canadian law firm or accounting firm selling services into Canada, this is designed to catch you as well as for entities that sell sort of truly digital services into Canadian market on a B2C basis. But for those entities that make B2B sales into Canada, whether or not you're required to register to collect the tax and the extent to which you're going to be required to collect the tax depends a lot on who your customers are, what that customer base looks like. B2C, easy to determine. B2B, a little bit more difficult, particularly because it is going to be based on the tax status from a GST, HST perspective of your Canadian customers. If all of your Canadian customers charge GST, HST on the sales that they make to their Canadian customers, that's fine. There's a carve out. You would not be required to be registered. But if some or all of the customers that you have in Canada are not required to collect GST when they make sales to Canadian customers, because some or all of the services or property that they supply are exempt from the application of GST, HST, you would actually, as a non-resident, need to charge and collect this GST, HST on the sales you make to those Canadian customers. So, to try and boil it down a little bit, for entities that sell primarily to financial institutions, to universities, to certain government entities, to certain hospitals or other medical services, it's likely that you're going to need to be registered, even if you're making only B2B sales, because a lot of what those entities sell in Canada are not subject to GST, HST. Those are exempt supplies. And so when you sell to them, you need to be collecting from them. And once you're registered, you have to do one of two things. You either have to ensure that the rest of your B2B customers in Canada are registered for Canadian GST purposes, or you need to collect tax from all of them. And that's sort of a strategic decision that would have to be made. And I've seen non-Canadians sort of make both decisions, depending on sort of the nature of their customer base. These new rules on the federal side, they don't only apply to entities that sell directly to purchasers in Canada. They also apply to operators of online marketplaces and other similar platforms that are designed to enable such transactions to occur. And this is both in Quebec, but also federally, it's a really major shift from the traditional threshold rules that generally only required non-residents to register if they had a really strong connection to Canada, what we refer to as it's a carrying on business test in Canada. And for anyone who has asked me, prior to July 1st of last year, does my company need to register for GST HST purposes in Canada because we've got a number of customers in Canada? The answer is typically going to be no, you're not required to. Simply selling goods, selling property, intangible property, or selling services to Canadian customers isn't sufficient to trip that traditional threshold of carrying on business in Canada. It's what we would have said before was, you're carrying on business with Canada, but you're not carrying on business in Canada. Until you cross that threshold, whether it's because you've got employees coming into Canada, or you've got office space in Canada, or you've got a number of other factors that are present that show a closer connection to Canada, you wouldn't have been required to be registered. That is now no longer the case unless you only sell on a B2B basis and all of your customers, or virtually all of your customers, are themselves registered for GST HST purposes. That, of course, is going to cover a large number of folks, but it's also going to exclude a large number of non-residents who have in the past chosen not to become registered for GST HST purposes on the basis that they aren't carrying on business in Canada. Now, in addition to this shift in our value-added taxes in Quebec and federally, the provinces of British Columbia, Saskatchewan, and Manitoba, they each have provincial sales and use taxes. And they've also made significant changes over the past few years, including very, very recent changes in BC, I think as recent as last week or two, in order to broaden their respective tax bases and to capture more sales tax on sales made to consumers in those provinces. And the law has always been in these three provinces, but also in Quebec and federally speaking, these types of services and intangibles that are consumed by Canadians, they've always been subject to tax, but they've always been subject to tax on a self-assessment basis by the consumer in Canada or the user in Canada. So whenever, in years past, people said, you need a Netflix tax in Canada, my sort of overly technical tax response was, well, we have one already. It's called the GST HST, or it's called the provincial sales taxes, to the extent that they would apply, because they require self-assessment by the user or by the consumer. But as far as I know, no tax returns have ever been filed by a consumer in Canada to self-assess tax on these types of imported services or imported intangible properties. And so all of these changes now put the onus on the seller. And it's no different in the three provinces with sales and use taxes. They have tried to achieve this by a couple of ways. In some cases, and I believe now in all three provinces, there are now new marketplace rules that require non-resident marketplaces that allow for sales to be made in any of these provinces to have to register to collect the provincial sales taxes. But also in some cases, they've simply extended and expanded on the general registration requirements for entities that sell to users or consumers in the respective provinces. I mean, really, the long and the short of it is, as it relates to all of the new sales tax rules, that if your company sells to Canadians and you're not presently registered to collect Canadian sales taxes, and even if you're a Canadian company that sells into Quebec, Manitoba, Saskatchewan, or BC, and you're not registered in those respective jurisdictions, now is the time to take a deeper look to determine whether or not your company needs to be registered to start collecting these taxes. Now, before we end things off here, I'm going to turn things back over to Ron, who's going to host a little question and answer for any questions that may have come in during our presentations.
Thanks, Paul. I have one question that has come in so far from on Q&As, and that question relates to the consultation process that the OECD has adopted, and whether or not you can make submissions to the OECD. And what the process has been so far is each time the OECD publishes a report, they take comments. So back in December, they published for Pillar 2 a report, or really the rules for Pillar 2, and they received about, I understand, 70 or 80 comments, holding about 600 pages in length. So they're reviewing those now. That comment period is over. They should be coming out with rules, proposed rules for Pillar 1, at least Amount A in Pillar 1. There is an Amount B, which I really didn't address. So there'll be a comment period for that as well. But these comment periods tend to be very short. And the reason for that is because implementation in terms of having a multilateral instrument for Pillar 1 is to be, that multilateral instrument is to be ready in the summer. And there's a similar type process for Pillar 2. So there is a consultation process that the OECD has adopted, but it is short. You'll also have opportunities to consult with the Department of Finance when they release draft legislation. That's typically the case, but I think that there'll be little leeway for the Department of Finance in terms of the changes it can make once it has agreed to Pillar 1 and Pillar 2 as finally settled. I don't know if there are any questions, any other questions? And I don't think so.
Ron, I see something that just has just come in.
Okay.
The question is there any indication how inbound digital sales will be audited or enforced for GST/HST purposes? So let me take that one. It's a good question. As I noted early in the presentation, with respect to the new digital sales tax, there are elements of the new legislation that will allow the minister to assess Canadian subsidiaries directly for we'll call it wrongdoings of members of their consolidated group that aren't otherwise in Canada. There are no similar rules for the GST/HST, and so to a certain extent, I suspect, and my gut is that a lot of what's going to happen on that side of things is it's going to be the CRA requiring, or Canada Revenue requiring people to be on their best behavior and sort of being good taxpayers, good social taxpayers, good community members with respect to paying their taxes. And a lot of it, I suspect, was designed really to get the big hitters out there, to make sure that, when you're buying on the Amazon marketplace, that there's going to be GST/HST on all of the transactions, not just on some of them and the like. And so I suspect that for smaller players outside of Canada that are selling into Canada that may be offside, it's going to be difficult for CRA to find them and catch them, and frankly, to enforce the requirements on them. I don't know how much they care. In terms of how they might actually audit and enforce, it's likely going to be, they're going to find it, a number of different ways. They are, and I've seen this in the past, sort of, many years ago when, Amazon was first coming into Canada, and around that time period, things as simple as newspaper articles that CRA auditors or folks at headquarters would read about, such and such a company is now coming to Canada for the first time. That was enough sometimes to trigger the questions. What are you actually doing here? Why aren't you being registered for Canadian tax purposes or for GST/HST purposes? And so I suspect there will be some of that goes on. And I suspect some of what will go on will be when they're looking at Canadians, particularly Canadians who are not fully engaged in commercial activities, meaning some of what they're doing is exempt from GST/HST purposes. Those types of entities in Canada are required to self-assess on any imported taxable supplies that they receive from outside of Canada. And so where they start to see large self-assessments, and unlike consumers who rarely self-assess or never self-assess, those types of entities, financial institutions are a great example, those types of entities do self-assess, certainly the vast majority of the time when they acquire those types of property and services. And so there's going to be a very good ability, with the CRA, they're going to have a great, what's the word I'm looking for here? There's going to be an ability to track those people because they will see, okay, bank such and such or insurance company X or Y, they've self-assessed on the acquisition of software from this entity. Well, we don't see this entity as being registered. Clearly, they are selling to a person in a circumstance where they would need to be registered. The next phone call then goes to those people. So they will be able to trace it. And I suspect that's going to be where they're going to trace it from. So hopefully that answers their question, or the question there. And Ron, I see another question that looks like it's going to be over for you. Do you see it there?
I think there's two more. One person asked that I sort of repeat some of my implementation considerations and Canadian considerations. I think that's because I had a little bit of Wi-Fi issues. I apologize for that. On terms of implementation issues, my main point was timing is very tight. The rules for Pillar 2 have been released, but we don't have rules for Pillar 1, and they both need commentary. And there is a process of consultation as well. So they're hoping on Pillar 1 to have a multimodal instrument ready to be signed in the summer. But even if that happens, it's a lot to ask 140 different countries to implement the rules that are proposed by the end of the year. And in the case of the United States, there will be an election. There is concern in the U.S. about Pillar 1 and the sharing of the U.S. tax base. And really, that sharing of the tax base is really a long-term issue. It doesn't result in reduced taxes immediately for the U.S. because the U.S. carries on, most U.S. multinationals carry on business internationally through foreign corporations. So it's a matter of when those profits are ultimately repatriated to the U.S. in terms of the shared tax base. But there's concern about that. So you could see the U.S. not go ahead with Pillar 1. That's a risk. If that happens, the whole project may either die or be deferred. In terms of Canadian considerations, Paul's gone over the digital services tax and how it depends on whether or not we have a Pillar 1 that's implemented. I mentioned that Canada doesn't use consolidated income or rules or accounting income for tax purposes, so that there'll be new complexities introduced to our Income Tax Act. I mentioned that our FAPI rules, it's not necessarily clear how they're going to interact with Pillar 2. Will we be providing a foreign accrual tax, essentially a credit, or tax above Canada, up the chain, where minimum tax is applied above the chain? That would be unusual. And I mentioned that some of our incentives within our foreign affiliate system, including paragraph 95(2)(a), and our whole exempt surplus system, those benefits are reduced to the extent we have minimum taxes applying to multinationals that carry on business in Canada and elsewhere. So those are some of the concerns I raised. We also had a question about the approach that the OECD or Canada will apply in dealing with sourcing revenues that are cloaked using VPNs, virtual private networks. I don't know the answer to that question. I'll have to take a look at it. There are lengthy reports they may have addressed the VPN issue. I just don't know the answer offhand. I think that's all the questions we had. I want to thank everyone for joining us. This is the first in our series of quarterly perspectives on tax. So thank you for joining us. Should you have any questions, please feel free to reach out to myself or Paul or any member of the Fasken group. We'd be happy to hear from you. There is a survey that will be available, and we appreciate it if you could fill it out. That'll help us improve our programming in the future. There are 3 more programs this year. The next one will be in May. So please be on the lookout for an invite for that. There'll be some communications shortly in the future. And once again, thanks very much for joining us. We appreciate that, and enjoy the rest of your day. Thank you.